Hello and welcome back to the Paperstac Podcast. I am Brett Burky here with TJ Osterman for second time on the podcast. Look at this, man.
Exciting.
That's cool. It's cool. Yeah. So we're going to be continuing with our fund series. So at the end of this video, we will have a couple other fund managers that are going to come on and introduce themselves, kind of showcase what they do, their funds. You know, we talk a lot about Paperstac, but we never talk about all the funds that are out there that might actually buy the notes on Paperstac or sell the notes on Paperstac. So we always want to show everyone some love.
There's some good ones out there that we've watched grow over the years for sure.
Very much so. Yeah. And all become really good buds.
Yeah.
Yeah, so really what we're just, you as a new note investor probably might have seen the last episode with Rick and TJ where they talked about probably best, get yourself around the track once, buy a note, then invest in funds. I myself do both. And it just matters. Really, I think it's just diversification. A lot of times, with some of the notes, when if you put too much with the fund, I feel like it's all eggs in one basket kind of thing. But if you have some notes, then some in the fund, maybe another fund, so you have a couple of different funds you're investing in, makes for a very safe type of investment. And there's also a difference between are you accredited or not. So that's
I think you have a really good finger on the pulse of that because you diversify a lot more than actually I do with different funds that you have. So it's also interesting to hear about like what you actually look for as well. Reading through the questions we're going to kind of go through. I am always interested in like finding out why did you choose that? Because sometimes you'll come in and be like, hey, I'm investing in this, and I'm like, okay, why did you look at that? Because there's a lot of noise out there, right? There's a lot like. How do you kind of cut through that noise and be like, oh, I like this? Is it somebody that you know? Because I know it's kind of a lead into what we're going to be talking about, but that can go a long way.
Most likely, it's someone I know. Because it's just that I know them as an operator. I just know that what they do, what they're buying, I talk to them at conferences. Mm-hmm. I hear from other people that are investors with them. They might sell a note on Paperstac. They might buy a note on Paperstac. So it's all in the same ecosystem. I thought I did do one thing where it wasn't notes, and it's not my path. I was going to do another one recently where I was going to do something for a tax strategy, and I was like, well, I have this amount of money, I could do this to get the tax strategy. I would have a huge write-off, that would carry me over for the next 5 years, and I would have to understand a whole different type of investment, and I was like, I know the note stuff. Like, let's just stick with what I know. And so for me, I was just like, I'm just going to call my buddy, and I'm actually doing it right now. I'm buying a partial it's a totally different conversation for a different day.
But it's interesting because I think what can happen to a lot of people out there is that you can start chasing shiny objects, and there's a lot of it now with technology and social media and what have you. And you generally, and I know some of the questions are going to ask that, like, why would you want to choose this one thing? It's generally you should have a little bit of knowledge into what you're investing in. Yes, over here, this guy might be offering all this, glitz and glamour. This one's not as sexy, but you know about it. It's kind of an art form in a way too, right? Because as we're going through these questions, some of these answers that I give, that's not like the only answer, right? Mm-hmm. Certain people evaluate different things each time, and I think that's what we're going to kind of get at too. Like you look at different stuff that I would never even think about, and I love it because it's completely sometimes out of the box. Mm-hmm.
Well, it's even like the partial I'm buying. Like I know the guy. Like he's a good friend of mine, and I know the way how he as a lender how he is. I've been out there and stayed with him in Texas, and toured his properties and learned about his borrowers, and so it's like. I'm buying this partial. It's basically buying a big enough partial to cover another underlying lien to take basically free money. So it's an interesting play. But of course, I have to make sure I can make the underlying lien. Well, with this partial, I'm like, I trust this guy. And he's giving me basically saying, hey, if things go sideways, I'll replace it.
That's one of the biggest questions I always ask. So let's dive into some of these and we'll do our best shot here.
All right. So I guess we'll just go with the ones you circled. Or those
there's only 3 there, so we'll just you interrupted me. We'll kind of go through them, and then ones that I just don't know, I'm just whatever.
Okay,
let's go through this. Let's start at the top.
Evaluating a fund operator, what are the first things you look at before you ever look at the returns?
I look at the person that they are. I look at what their beliefs are, because as an investor, I really want my money to be invested along something that I kind of believe in. And I think it touches on what we talked about before. It's, a shiny object over there. However, they are dealing in such and such and such. And I'm like, not for me, right? Even though if it's a good return, I'm not that type of person. So when I'm looking at something or somebody, I'm going to look at the person that they are. I'm going to talk to them. I feel like I have a really good, a good sense of how somebody is, right? You hope to, right? It's not guaranteed, but so I'm always kind of looking at what they've done in the past, what they're looking at doing, what they're doing currently, and kind of their history.
Okay.
Yeah.
So basically, with that evaluation, you're really looking to say, hey, is this person focused on capital preservation? Because shiny objects, I've in a lot of different groups, and I've seen some people chase some stuff that was shiny objects, and they lost their butts. And it's because returns are great, but capital preservation is better. If someone runs off with your money and you don't have it, it's better than that's way worse than like even a 5% return. So like something that's secure.
And sometimes you can't model in things that happen. Like when I first started our fund, had no idea COVID was coming. When that happens, you can't go out. You can't go out and raise capital. You had to be stuck inside. So what did we have to do? We had to do a digital marketing campaign to try to raise money, and it was very difficult. So what this is all saying is that no matter what you do, if you try to pencil everything out, everything looks great. You never know. There's always that unforeseen stuff. So you have to there is that risk factor, right? There's always going to be that risk factor. But as long as you feel comfortable with that person and what they're doing, what they're investing in, you want to get behind it, then it's good.
Okay.
Yeah.
All right. So how did you get started in managing funds and investors' capital? Because you've been doing this for a long time.
Well, yeah. Rick and I first started buying and selling homes, right? Wholesaling stuff. And then we had an opportunity to buy a note. We did good on this note. We didn't know what we were doing at the time, but we didn't blow our legs off, we like to say, and we made some money on it. And then we went out and raised some capital to buy more of these notes. So we saw that there was an opportunity to grow something, and there was a lot of it out there to get. So we looked at, okay, who do we know first and foremost, friends and family, close people to us, that would believe in kind of what we were doing and what we had. And what we had was a spreadsheet with returns and some numbers and some math. And it was really easy because it was like 1 or 2. And it was done. That makes sense. We made really good money. Can we rinse and repeat that? And so we decided, well, we can, yes. And that's when we decided to go on this whole note journey, getting education, and then eventually launching one of the first Regulation A+ funds out there. And that was an interesting journey for sure. But that was kind of our journey. We thought we could scale this thing, and we did really good scaling it. Happened chance, some bad timing on the fund itself. But that's when you learn a lot. And boy, did I learn a lot.
I mean, it
was lots of experience from talking to investors when things didn't work out the way that I planned, auditing, the audits that we went through,
those are fun,
dealing
right?
with the SEC. There's all these different levels. And some of the questions are going to ask, and we can kind of go on here of like, what are some of those things that you actually learned about, and what shouldn't you do when you're a first-time fund manager? And I know those really well.
Okay. All right. Next question here is, what are some of the biggest mistakes you see new fund managers make?
Well, I can't talk about all new fund managers, but I can talk about one new fund manager that I know, and that would be me, right? When I first started MWM Fund, the biggest mistakes I made was focusing on getting all the little bits and pieces in place and spending way too much money before we even kind of went to market. Putting all the infrastructure, you were a part of that. Remember how much time it took for each and everything? And I tried to make it too perfect, right? And I built this big machine that needed a lot of money to continue to go every single month. When I look back at it now, I would have done it less. I probably would have gone to a Reg D fund, which more accredited investors, so I didn't have to put in so much infrastructure, right? So I overdid it. I built this big, huge, beautiful looking machine, marketing campaigns, messages. We spent a lot of time and money just on hiring people to do that, and ended up being, $15,000+ a month in overhead.
Yeah.
Before we started actually bringing in stuff. So that was the biggest mistake, I think, that we made. The notes were solid. There's always opportunities out there, right, to buy and sell these things. But that's the biggest thing is a new fund manager, you have to go into it, kind of know what you're doing. We did our education, but don't build too big right in the beginning, right?
That's fair.
I mean, do your homework, put all the stuff, the things in place, but just you don't need to go 1,000 miles an hour right away.
Okay, I like that.
Yeah.
Okay, so next question. Now we're going to just throw you for loops.
Okay.
Because these aren't circled, so.
No, yeah, just go out there. We'll see.
Let's see. What question should every passive investor ask before investing in a fund?
What question?
Yeah.
Well, what's the return?
Yeah, that's a good one.
And who's managing the fund? What's their track record? What's the history look like? What are they investing in? What are their beliefs? What are their goals? It's like I said, this is an art form. This is for somebody that's looking to put money in and they're just going to set it and forget it. You really have to ask the person, what are they investing in, and do I understand it at all? And if it's something that you can't explain to your wife or mother or father, maybe you should, refine what you're looking at. Because if it can't be explained simply to somebody and you don't really know how to explain it, generally isn't that the biggest sign that you don't know what you're talking about?
Yeah, but if that's the case, and I don't know what I'm talking about anything, because I explain stuff to my wife, and she thinks someone asked her, "What does your husband do for work?" And she says he works in the internet.
Yeah,
and I was like,
that's the same as
I just wake up and just jump through the screen, and here I am, like lawnmower man
in the internet. But that's the same with my wife. It's the same exact thing. Like it's a difficult thing to explain sometimes, but you should be able to kind of understand that.
I can explain what a note is and stuff like that.
Right.
I think she gets it. I think she just doesn't care.
Yeah.
What would be some red flags that would immediately concern you if you're looking at a fund?
The first and foremost is like promising the world. It's just like, it's so hard when times are tough. You're kind of, just making ends meet. You had a little extra money, you want to invest, and somebody, out there is promising the world. That's what they prey on, a lot of these, scam artists, and they're just going to promise the world, and people get caught up in that. So it's like, try to not invest with emotion.
Yeah,
try to invest off of like facts and data, and because it's really easy. You coming from the marketing world, you can really hype something up.
Oh yeah.
If you're trying to sell something, you can hype it up, and that's the scary thing to where that can happen. So that's pretty much the biggest thing is if somebody's promising you a 20% guaranteed return, it's a red flag.
There was a company that a lot of my friends invested in it was not notes that were like mortgage notes. It was notes that were like on like Barnes and Noble or something. It was something crazy like that. And I was like, what? And I was like, I didn't get it. Mm-hmm. But the returns were like astronomical. I was like, no freaking way. It was like 40%. And I was like, oh yeah, we get, like this much. But the thing that got me where I was like, yeah, no. It was because the guy was persistent. He was annoying as hell. Like he would call me, like, "Hey, you ready to go? Let's go. Let's get this money in." I'm like, "You are a car salesman." No offense to car salesmen.
That's a great is like.
He was persistent, trying to get my money, and I was like, "Dude, I'm going to evaluate it on my own time, and if I want to invest, I'll invest." But stop hounding me. You're already annoying me. I don't want to invest with you. And everyone that I knew went with them. They lost their butt.
Yeah. Well, there you go.
They lost their money. Those people went away and packed up and it.
You just sometimes and like I said, sometimes you're gonna take a shot on goal and you miss it. I mean, you take more shots as an entrepreneur. You take more shots, you miss more shots than you actually make, and that's okay. Yep. You just kind of get that feeling.
So with that, so being that we're talking about mostly like performance issues, and not the ones in the bedroom. We're talking about your fund performance issues. How much concern would you really take to like the returns on consistency? I mean, there's going to be ups and downs. Nothing's a 100% perfect home run. Like I would almost say, if someone, of course, has failed and maybe some of their investments, I think what they did to solve that really speaks numbers and volumes of who they are.
Yeah.
But people will have, they're not 100% track record. What do you think about that?
Well, no, because an investment itself is volatile and risky, right? So it's like, yeah, I know this guy's investing in, people with 800 credit scores, first position mortgage notes that are 50% loan to value. Could that go non-performing? It could, right? I mean, everything from the whole shell, the whole note looks beautiful. This investment looks great. I know the fund is buying. That's all that they're investing in, and they all look great. But you never know. So it's those unknowns, right? And that's the big thing.
That is the big thing. I'd have some friends that own funds, and a couple of them, the way they structured it, I was like, well, that's pretty smart. Like one group puts, I forget how, they have 50 million, they'll put certain amount of million into like the S&P to like offset if things were to go wrong and they have to cover stuff for, they've got like 5 million in the S&P. Like, so
they hedge their...
They're hedging.
Yes.
They're hedging. So they're knowing, hey, if this something goes wrong, we're at least able to cover our investors until we bounce back. And then the other one that I know has no debt. It runs a large fund and is completely debt free.
Yeah.
He's an operator in the sense that he has all these different people, working for him, and everyone's pulling a different lever. So that's definitely one of the things that looking at those funds, I find that interesting because you're like, there's a lot of structure to this.
It's different for each person too, right?
Yeah.
But yes.
All right. So let's see. That's the track and performance. How often should fund managers communicate with their investors?
It's a tough question because fund managers, there's a lot of work going on there. So, some form of them should communicate with an investor whenever they need answers. Might not be the actual fund manager itself, but they should have people there to be able to answer your questions.
Right.
That's the biggest thing is. And, one of the signs of, I don't know if we're going to get into that, of like, what are some of those red flags that go off is when you start calling and nobody starts answering, that's when people start freaking out. So you should always, and you know this better than anybody, it's that be able to reach out and touch somebody and tell them, even if things are going sideways, I had to call all the investors and personally talk to them. It wasn't the funnest thing to do, but that's what you had to do. And you needed to do that to be able to maintain your, that's the type of person you want to be. That's what I'm all about, right? I'm a reputable guy that's a stand-up individual that doesn't run from my mistakes, right? Or run from tough questions, right? Because it's not always going to be, if everything's great,
usually you won't get a phone call.
But it doesn't work that way. Something happened, I need my money back out, I need to do this fast, whatever it may be. I think that's the communication, especially in today's day and age, like there should be no time that you cannot get answers to. If your money's with somebody, what's going on? A big thing that's been going on lately is that you've seen is like funds putting, they're saying you can't take out money.
Like a hold period.
So a hold period, or we're just stopping distributions because we're not allowing you to take out your money. And that's like at certain levels, that's what happens, and that's a strategy. But you have to be able to accept that and understand that can happen. So that's we're running through the paperwork on the funds and what the fund's mandate is. If there's an ability to do that, which most funds there are, they can stop redemptions. They can say, we're not giving you your money back because we need to help this thing continue to live, right?
Makes sense.
So you have to know that can happen, right? And are you okay with that? So
yeah, I get that.
Yeah.
How important is the team behind the operator?
Oh, it's everything.
Really?
Oh yeah, the team, because it takes a team. It takes a village, right? There's that saying, it takes a village to raise a kid.
Yeah.
Can you just do it yourself? You can't, it's tough, unless you have but when you have family and friends around you, helping you, supporting you, and doing things, it makes things a lot easier. So that team, and the team I think today's in day and age is not just humans, like with AI. Like nowadays, like are these people properly using AI, right? Like are they utilizing this as part of their team? And not just asking it, can you create me a grocery list for, Sam's Club for the next week. I mean, people that are literally in there really working with AI. I think nowadays that's an important thing to ask, because the funds that are utilizing AI properly, I think, are able to react and act. And how they always said in Silicon Valley, fail quick.
Yeah.
With AI, you can fail really quick a lot of times.
Yeah.
And ask it good questions and get to the result.
No, I get it.
That's a lot with investing, right? So that's kind of, I think, how the team has changed. But there still needs to be that human element and being able to, communicate with them. And the team is pretty much everything. I think that's such a cliche answer. But.
That is a cliche answer, but whatever. It's true. It's not like a lie.
It's just me.
It's just me.
I'm the only one.
Yeah. I mean, sometimes AI too can be wrong.
Oh yeah,
like I was running some scenarios last week. I was for this new investment I'm doing, and I was mapping out till I was reverse engineering retirement. If I went all the way to the end.
Yeah.
Like my youngest will be out of school in 6 years, which would set me at like 53, and I'm like, would it be done with everything? Can the night will I be good? And so I was running the strategy all the way out to 53, so I can actually reverse engineer the thing and actually meet my goal. But it was giving me numbers that were like off, and I was like, well, wait a second, you're not accounting for this. Oh, you're right. I'm like, I trusted you to I'll be.
That's right.
You had me working until like 90. You're like it's like
there's a proper way to do it, right?
Well, maybe it might have been my user error. Maybe I didn't say it correctly, but I was trying to have it understand the cash flow and the returns.
Yeah.
And so it was missing that, and I was running it in a spreadsheet, and I was like, well, this is that, But it's a lot, because with notes you have things that there's maturity dates and things drop off, and so what does that do to your number? And those things are. But that's where I was relying on it. And actually, I changed my AI to not be nice to me. I kind of think I might have to change it back just slightly. But because now it's like, what do you want? I'm like,
shut up.
Well, I went into the settings.
My soup's cold.
I went into the settings and changed ChatGPT to be. I said, hey, look, give it to me bluntly. Don't sugarcoat it. If my stuff's wrong, tell me it's wrong. Don't be too nice. I'm tired of you. You spend too much time with niceties.
Yeah.
I want you to be more like a robot.
It does, without going on a tangent on AI though. It's like you'll put in like an idea.
Well,
and it'll be like, that's the best idea I've ever heard. And you get all excited, and then you're like, well, let's break this down. You're like, beat this thing up and tell me what really needs to be done.
Yeah.
So that's the proper way of doing it. But that's, to bring it full circle back around, that's really the team that we're talking about. Because like Paperstac, without our team, without Brett, without Rick, without everybody that's on the team, we wouldn't be what we are. I mean, we all have our, if we were doing this by ourselves, how scary is that really? I mean, you're like, holy cow. I mean, am I right? You always want to have that.
No, you definitely need a team.
Yeah.
I can't do what you do. I can't do what Rick does. I can't do what Mike does. I can't do what Mark does. I can't do what, can't do what Miriam does.
Exactly.
I mean, I know what to do, how to do what I know how to do. That's it.
I do what I do.
I do what I do. So that's everything here. Now, what we're going to do now is we're going to have some of our friends that have funds. I give them a list of questions, and we're going to let them roll and answer those questions so you can stick around and see. These are some of the funds that we've known for, almost a decade.
And are very successful and very, very sharp guys. We're
guys and gals. There's a girl on there.
Guys and gals. I apologize. But yeah, I mean these people really are. They know what they're doing. And it should be valuable. I mean, I'm excited to watch it.
Yeah. Okay. Yeah. Cool. Yeah. And then that's pretty much it for this one. There's another one with TJ Osterman. He's becoming the host now. So
I can't take that away from you guys. You guys do such a good job. They just bring in the
brings in a whole new style.
The lackey.
And then a whole new style.
Right. Yeah.
So that's it. We'll see you on the next one.
All right. See ya.
Hey, my name is Nathan Turner. I am the operator of the Earnest Investing Fund, and we buy first lien mortgages and contracts for deed, anything that is a loan attached to a property. That's what we buy inside that fund. So I've been asked to answer some questions and help you figure out a little bit about what we do and how funds work in general, and I'm happy to be a part of this project. What is your minimum investment, and what does a typical investor look like in our fund? So the minimum investment for our fund is $50,000 and a maximum of $1 million. And the typical investor for our fund is somebody who is either using IRA capital, money that they've got sitting in an IRA that's probably underperforming. This is a great vehicle for that, or it's cash on hand that you just like to have go to work for you. We offer an 8% annual return, and my lawyer says I'm not allowed to say guarantee, but what I can tell you is we pay 8%. That's not too much of a challenge for us. that is what that looks like, and that investor is just somebody who's looking to have their money work for them instead of working for it themselves. So the second question is to walk you through what the first 12 months look like in our fund. So ours is very simple, very streamlined. You wire your money over into our fund account, and then from there I go shopping and I go to see what loans I can find that fit the available capital that we have and that fit the parameters of our fund. So I buy no less than a 12% yield, and then that gives me a buffer where I can still get myself paid and make sure that our investors are well taken care of. So it may take me a couple of months to get that deal bought, probably less than that, but let's say it takes a couple of months. In the interim, you are still earning your 8%. So that has been accruing the whole time. We pay you out as soon as we can for that first quarter, as soon as that first quarter comes around, and then we get you caught up by the end of that first year. So that within that first year, you still met that 8% annual return, and then that's what you can more or less count on as time goes on. Again, according to my attorney, that's what I can say. So how do I decide which deals to buy and where do those deals actually come from? So I look all over the place. I run the Diversified Mortgage Expo, and that allows me to have a wider audience. So I get a lot of people actually just coming to me pitching their deals, and as I have capital available, I take down whatever I can that makes sense within the fund. Like I say, I buy at a minimum 12% yield, just to make sure that there's enough cushion there that it's going to protect the investor as well as myself. So that deal flow really comes from all over the place. I look for online deals. A lot of people just send me their deals. I can go looking for those deals if I need to, and I've got lots of different sources. I've been in this business more than 15 years, so I've got lots of contacts that I can tap into whenever I need if I've got a larger sum of money that I need to deploy. Next question is, what is the worst quarter I've ever had? So the worst quarter that I think I would fit that definition is the quarter where maybe they joined in, say, March, and payouts come out the next month because that's April. So for that first quarter, they probably aren't going to be receiving anything because I haven't had time to deploy and then start receiving payments to come in. So that's well communicated with the investor just to let them know what's going on. Everything for me is personal touch. I send out, personal emails every quarter just to tell you what's going on. Any questions in the meantime, I'm happy to answer those. But that's how that is communicated. That's probably what I would consider the worst quarter, is just because you've just got started and haven't been able to start receiving any capital yet, any of your return yet. So if somebody's watching this video and has $50,000 to invest, would it be worth it to invest into the fund, or would it be better to buy a note? And really, that really comes down to whatever your priority is. You as the investor, if you're looking for something completely hands-off where you don't have to think about it, that's probably a fund, mine or somebody else's. If it's you want to be more involved and you want to understand the mechanics of notes and how they work and all the different ins and outs, go ahead and buy a note. There's certainly lots of them out there. Paperstac is a great source for that. So it really comes down to your priorities, the thing that you're looking for best. I'm happy to help you out either way. I love talking about notes, and I'm happy to just walk you through whatever deal you're working on. So feel free to reach out. This has been great, and thank you so much.
For my fund, the Integrity Income Fund, which we've had for over 4 years now, the minimum investment is $25,000, and every investor needs to be an accredited investor. You can Google that or ChatGPT it if you're not unsure what that means. So typically, we're dealing with people who have a good amount as far as net worth. And we have 2 levels in our fund. The $25,000 is the minimum, but to get to the next yield, targeted preferred return, I should say, of 10% annually, you need to put in $100,000. As far as what the first 12 months look like in our fund, honestly, it's pretty boring. It's pretty boring from the passive investor's standpoint. Once they complete the subscription agreement and other required documents, we get the funds into the fund. They will get their distribution within the first 2 months. And I say will. There's always risk. There are no guarantees. But we've never missed a distribution in the 4 years that we've operated the Integrity Income Fund. And but the intent of the fund when we set it up was for it to be simple, somewhat safe, and boring and predictable from the investor's standpoint. So what the investor receives is a monthly distribution based on their capital invested and their targeted preferred return, which is either 8% or 10%. And they also receive a monthly update from us. We put a good amount of effort into communicating with our investors and providing transparency with regard to the portfolio of notes that we manage. So from wire to distribution to year-end reporting, which is the Schedule K1 that we issue, there's not a lot happening for the investor other than receiving their deposit into their self-directed IRA account or their personal account or business account, whatever account they're investing through. How we decide which notes to buy in our fund, that's a great question. It's very nuanced. We do have a decent amount of discretion within written into the fund docs with regard to which assets we're able to target and purchase and even sometimes originate. We buy primarily first lien performing and reperforming mortgage notes. This puts the investor at a little more ease with regard to safety and security and with regard to the collateral that's backing the asset. So I'm a first lien mortgage note investor primarily, although we do buy some seconds in the fund. We do buy some land notes in the fund. We have originated some loans within the fund. But our focus is on primarily reperforming mortgage notes where the collateral value is estimated to be at least, where the purchase price of our note is typically below 70% of the estimated property value. I think our average currently across the fund with regard to ITV, which is investment to value, is well below 40% actually. So the collateral value backing the notes that we buy is considerably higher than the amount of capital that we invest in purchasing those notes. More specifically with regard to which notes to buy and where our deal flow comes from, quite honestly, we buy mostly from other note investors and through our own internal network. I've been active in the mortgage note space for since 2018, so over 8 years now, and I've developed a network of sources and resources, vendors, peers, attorneys, etc., that all really help us develop our deal flow. We do use Paperstac and other online sources, but frankly, the most fruitful sources end up being the people we know, like, and trust. And I end up going back to the same people that I've bought from before because I trust them and they make it easy. What's the worst quarter we've had? Well, I would actually say, other than the first quarter launching the fund, from a financial standpoint, there's a lot of investment up front to get the fund off the ground. It was probably actually the fourth quarter of last year, and it wasn't so much poor operations or anything like that. It really had to do with the fact that we purchased several non-performing loans, specifically HUD-HECM loans, reverse mortgages, which are typically underwater, deceased borrowers, vacant properties, and we had a lot of upfront legal expenses all at the same time, primarily because of that purchase. And so one of the challenges with running a fund is the capital management. And so you either have too much cash on hand or not enough. And so the end of last year, that fourth quarter wasn't ideal from a profit standpoint with regard to the fund, not because we'd exited deals for a loss, but because we'd purchased deals that required a lot of upfront investment and expenses. So we're looking a lot better this year already. If someone had $25K to invest, would I tell them to invest in my fund, or would I tell them to buy a note directly? I'm going to have to fall back on my attorney-like answer, which is it depends. I did a presentation for the Cash Flow Expo with Fred and Tracy this year that was all about understanding your investor avatar. And I think this is the step that many investors skip. They think note investing is sexy, or just real estate investing in general sounds cool. I want to get into this. They see the benefits. They see they don't have to deal with tenants, toilets, and trash. They see they can invest from anywhere, but they don't really take the time to understand what it is they bring to the table with regard to experience and time, frankly, and what it is they're looking to achieve. So I can't answer that question. There are many perks to investing in a fund, such as diversification. You're spreading out your risk across multiple assets versus buying one. If you buy one whole note, you're putting all your eggs in one basket, essentially. But if your goal is to be an active mortgage note investor, I would not recommend investing in a fund. You're going to learn very little as a passive investor, and you're going to learn much more by buying your first note. So it really depends on the investor's experience, time allocated, and their goals with regard to whether they should buy a note or invest in a fund. As mentioned previously, my fund is specifically for accredited investors. So if you're not accredited and you do want to invest in my fund, I would recommend increasing your net worth or increasing your income so that you can qualify as an accredited investor. But I think the larger question is, what do I want out of this? And last year I did a presentation for the Cash Flow Expo in 2025, which was all about the spectrum of passivity, or the spectrum of passiveness. And there are a lot of ways to be a note investor that are not quite active and not quite fully passive either. We offer mentorship and we offer asset management services, and those cater to more of the active investor and more of the hybrid investor who wants some control but doesn't want to invest in a fund and doesn't want to be entirely passive. So it really depends on the investor's situation and their goals. If anyone has any further questions, labradorlending.com is our website, and the Integrity Income Fund is our fund. Thanks.
Hi, I'm Leilani Piramali, and I'm an investor relations manager at 7E Investments. And one of the questions that we get most frequently from people exploring note investing is whether or not our fund is a good fit for them. And my answer is always, it depends. So let me answer that question with another question back. Do you have the time, bandwidth, and appetite to climb the learning curve that is buying and managing notes directly? This is not to discourage you from that path at all, but the learning curve is real, and for the right person, it is worth it, but it is a commitment and it helps to go in with eyes wide open. And here's something that might surprise you. A lot of our fund investors are already active note investors. They know the asset class, they understand how it works, and they've chosen the fund as a sort of complement to what they're doing already. So they're not choosing between us and doing it themselves. They are doing both. So if you're brand new to note investing and want to learn by doing buy a note, that experience is absolutely irreplaceable. But if you want exposure to this asset class while that learning is happening, or alongside an active portfolio that you're already running, that is exactly what we are here for. Our minimum investment for our Reg A offering is $5,000, and this is open to both accredited and non-accredited investors. For our Reg D offering, the minimum is $50,000, and that is limited to accredited investors only. One of the profiles that we see most consistently is the self-directed IRA investor. So these are people who've already done the work of setting up the structure and are now looking to put it to work in something beyond the standard brokerage menu. For them, a mortgage note fund makes intuitive sense. It's an asset class that they can understand inside a tax-advantaged account that was built to hold it. Beyond that, a lot of our investors are coming in with some prior real estate background. They understand asset-backed strategies, they're comfortable with a certain level of illiquidity, and they're looking for yield that is not moving in lockstep with the stock market. And the common thread across all of them is that by the time they get on a call with us, they've already done their homework. We're not explaining what a mortgage note is from scratch. We are talking about fit. Once your funds settle, we build out your investor profile in AppFolio, and this is your portal. It is where you'll find your documents, your contribution history, distribution records, your 1099s at year end, and where you can update your banking information for receiving those distributions. Here is how the timing works, and I want to be specific because this question does come up a lot. From the month you invest, you begin accruing interest the following month, and then your first distribution hits on the first of the month after that. So for example, if you invest in May, you'll begin accruing interest in June, and then you'll receive your first distribution on July 1st. No ambiguity, clean, predictable. Something worth knowing is that we've never missed a distribution, and every single distribution has been paid on time. For investors who are used to the variability that comes with direct note investing or really any real estate strategy, that consistency stands out, and it's something that we are genuinely proud of and aim to protect. What we really want people to understand is that when you invest with us, the journey's just beginning. We have a full team here to support you at every step, from navigating that self-directed IRA paperwork before a single dollar is wired to getting your tax documents to you at year end. Everything is handled in-house. So this isn't something you have to figure out on your own. We're here for all of it. Whatever questions come up along the way, you have a real team behind you, and that's the standard that we hold ourselves to. Note deal flow does not come from a single source, and I think that's actually a really important point for anyone evaluating a fund. Concentration in one pipeline is a risk that is not always talked about. So our deal flow comes through a combination of established service relationships, broker networks, and platforms like Paperstac, which, full circle moment, is exactly why being here makes so much sense for us. The best analogy that I can give you for how we approach deal selection is cherry picking. In January alone, we saw $2 billion in deal flow, and we purchased a very, very small percentage of that, mostly from Paperstac. Not because good deals are scarce, they're not. There's plenty to go around in this market, but it's because we're selective on purpose. When we're evaluating a note, we're looking at three things. We're looking at the person, the predicament, and the property. So the property is telling us what the collateral is actually worth and whether it supports the position. The predicament tells us why the note is available in the first place and what resolution may look like. And the person tells us exactly who we're dealing with on the borrower side and what the most likely path forward is going to be. All three have to make sense. So if any one of them doesn't, we pass. What investors are buying into when they come into the fund is not just access to notes, it's access to our specific filter.